Think about how a child grows. You see incredible leaps in development, right?
Hmm.
But there are also bumps along the road, maybe a fever, a bit of sickness, and of course some medicine or even a shot to help get back on track.
Yeah, those growth spurts and setbacks.
It might surprise you, but the world of financial markets has a similar kind of life cycle. You've got these surges of innovation, then regulation steps in as a form of necessary restraint, and sometimes we face a crisis.
Often a result of how that innovation interacts with the existing system.
Exactly. And frequently, that crisis becomes the spark for the next round of change.
That's a great analogy. What's fascinating is recognizing that these three elements, financial innovation, regulation, and crisis, aren't isolated events. They're deeply intertwined, really forming the continuous metabolism, you could say, of the financial market.
Precisely. And that's exactly what we're diving deep into today. Our goal is to uncover the fundamental connections between financial innovation, regulation, and those moments of crisis.
Yeah, understanding that interplay.
By understanding this interplay, we're aiming to give you a more comprehensive and insightful grasp of how the entire financial market operates.
If we connect this to the bigger picture, it's about understanding the engine that powers the financial world, its inherent drive for change, and also, well, its potential vulnerabilities.
So, in this deep dive, we'll be exploring this dynamic, drawing on some really compelling historical examples. We'll look at the cautionary tale of the South Sea bubble,
A classic.
the evolution of the U.S. financial market from its relatively freewheeling early days before the 1930s through the 1929 crash and the subsequent Glass-Steagall Act,
Hmm.
then the period of deregulation after the 1980s leading up to the subprime mortgage crisis. We'll even examine the more recent experiences of China's financial market, particularly with the emergence of internet finance.
This raises a really interesting point. What exactly is financial innovation at its core? It's not just about the latest gadgets or products, is it?
You're spot on. We'll be making the case that at its heart, financial innovation is actually a revolution in thinking.
A revolution in thinking. Interesting.
Yeah, we'll explore how seemingly straightforward ideas like national debt and joint stock companies represented truly profound shifts in human understanding. We'll also delve into this often tense love-hate relationship between innovation and regulation and grapple with whether financial innovation is ultimately a positive or negative force.
Okay.
So, get ready, because we're about to take a fascinating journey to unpack this complex but vital topic.
Okay, let's unpack this by starting with that first compelling example you mentioned. The South Sea Bubble in the 18th century UK.
Absolutely. The South Sea Bubble provides a classic illustration of this whole innovation regulation crisis cycle in action. Picture the scene. It's the early 1700s, and the British government has a massive debt burden after the Anglo-French War.
Right, they needed a solution.
Then comes this financial innovation, inspired by the Dutch East India Company, the creation of the South Sea Company. The core idea was a debt-to-equity swap.
What's fascinating here is the ingenuity of this early form of what we now call financial engineering, creatively structuring financial arrangements. Essentially, the South Sea Company took over £9 million of British government debt
A huge sum back then.
and converted the government's creditors into shareholders in the company.
Exactly. So overnight, the government's huge debt was reduced, and the relationship with its creditors shifted from a simple debt obligation to a shared stake in the company's potential profits and losses.
A risk-profit sharing model, basically.
Right. Now, this wasn't necessarily a bad idea in itself, but because the South Sea Company had done the government a solid, they received some significant benefits in return, including exclusive trading rights in South American waters.
Ah,
Here's where it gets really interesting.
if we connect this to the bigger picture, you can see how easily the lines between public and private interests can become blurred, potentially creating an environment ripe for speculation.
Precisely. The government's backing, combined with these exclusive rights, generated enormous hype around the South Sea Company's stock. Rumors began circulating whispers of vast gold discoveries in Peru and Mexico.
And with limited communication back then.
Right. Remember, communication wasn't instant, so these rumors really took hold and fueled the excitement. The stock price went completely wild, increasing tenfold in just 18 months to over £1,160.
That figure is astonishing. You mentioned an equivalent in today's money.
Right, that would be roughly £300,000 today. Just staggering. The whole of Britain seemed to go stark crazy. Even prominent figures like the king and Isaac Newton himself got caught up in the frenzy.
Newton, wow.
Yeah. Getting hold of South Sea Company stock became incredibly difficult.
This reminds us that market psychology, the fear of missing out, That's a constant factor in financial bubbles, regardless of the era.
Absolutely. And because people couldn't easily buy South Sea stock, capital started flowing into other newly formed joint stock companies. Suddenly, anything with joint stock in its name was being sought after and hyped.
So a spillover effect.
Exactly. Assets across Britain were rapidly being financialized and inflating like a giant balloon. Now, with all this irrational enthusiasm, calls for regulation naturally began to surface. The government, concerned about the entire economy becoming dangerously inflated, decided to intervene.
And this led to the introduction of the Bubble Act in 1720. What was the main aim of this regulation?
The Bubble Act was intended to address the rapid proliferation of these joint stock companies. A key provision was that any new joint stock company had to obtain a royal charter, essentially a license from the crown to operate legally.
Okay, so the objective was to bring some order and control to what had become a very chaotic market. But as we often see, regulations can sometimes have unexpected consequences.
Absolutely. The regulators didn't fully anticipate how much market expectations and investor sentiment drive the financial world and how quickly pessimism can spread. Overnight, a huge number of joint stock companies became illegal because they lacked this royal charter.
Oh, wow.
And what do you think happened to the stock prices of these suddenly illegal companies?
They would have likely plummeted, triggering widespread panic selling.
Exactly. Shareholders desperately tried to sell their now worthless stock, and this wave of negative sentiment spread rapidly. It wasn't just the questionable companies that were affected. Even the South Sea Company, which the government had intended to protect, was caught in the downturn.
Contagion.
Yes. The South Sea bubble burst dramatically. The stock price collapsed from over £1,000 to under 100 in just a few months. Newton, famously, reportedly lost a significant portion of his wealth.
Even Newton got burned.
Right. The entire British market was thrown into disarray and bankruptcies were widespread.
And this crisis had a long-lasting effect on how the UK viewed and regulated joint stock companies, didn't it?
It did. The British government, perhaps understandably after such a dramatic crash, developed a very negative view of joint stock companies for the next century. This actually led to the UK falling behind other nations in their development.
However, it's interesting to note that even with this negative regulatory environment for equity markets, the need for capital didn't simply vanish. The Industrial Revolution was starting.
Precisely. The Industrial Revolution was gaining momentum, requiring massive amounts of capital to fuel new industries. So even with a stagnant stock market, British investors found new ways to pool their resources. This period saw the rise of trust funds as a mechanism for the middle class to invest in the burgeoning real economy.
So innovation finding another path.
Exactly, a different kind of financial innovation driven by the circumstances.
So what's the key insight we can draw from this historical episode for our understanding today?
The South Sea bubble really clearly demonstrates this cyclical pattern we're discussing. Financial innovation creates a boom, which then often leads to regulation, which can sometimes trigger a crisis, and that crisis in turn can spur the development of new forms of innovation.
That cycle.
It really establishes this love-hate relationship between innovation and regulation as a central theme in financial history. The key insight here isn't just that bubbles happen, but that they often arise from seemingly ingenious innovations interacting with a regulatory environment that hasn't caught up, and how even attempts to fix things can have unintended consequences.
Yeah, that really sets the stage. It's clear that this cycle of innovation, regulation, and crisis isn't unique to 18th century Britain. You mentioned that the US and China offer further examples of this dynamic.
Absolutely. The fundamental pattern seems to repeat itself across different times and places. Let's look at the US market before the 1930s. It was largely a period of what you could call absolute liberalism, with very little in the way of financial regulation.
Another wild west of finance.
Sort of, yeah. As a result, financial innovation was happening constantly, and it triggered numerous smaller crises. Think of them like the minor illnesses a child experiences while growing up, often manageable, but a sign of ongoing development and adaptation. Little fevers, like you said earlier. And it wasn't until the profound shock of the Great Depression, 1929, that this largely hands-off approach really shifted.
Exactly. The sheer scale and devastating impact of the 1929 crisis finally compelled the U.S. government to intervene significantly and establish substantial financial regulation. The landmark piece of legislation here, of course, is the Glass-Steagall Act of 1934.
Right. What were the key provisions of this act that fundamentally reshaped the U.S. financial landscape?
Glass-Steagall put in place some really fundamental structural changes. It mandated the separation of commercial banks from investment banks,
Splitting them up?
with the aim of preventing the kind of speculative activities by commercial banks that were seen as contributing to the crash. It also introduced restrictions on insider trading and established controls on interest rates.
So it created a much more segmented and controlled financial system. But, as we saw with the UK after the South Sea bubble, regulation doesn't necessarily halt innovation, it often redirects it. Precisely. The decades following the implementation of Glass-Steagall became an era of financial innovation that, in many ways, sought to navigate around these new regulations.
Finding ways through the rules.
We saw the emergence of new financial tools and practices that gradually began to blur the lines once again between capital markets and commercial banks, effectively creating new regulatory gray areas. Then, after the 1980s, there was a significant movement towards deregulation, a deliberate relaxation of many of those earlier constraints.
And this period of deregulation, combined with other prevailing economic conditions like low interest rates, ultimately paved the way for the next major crisis.
Absolutely. The relaxation of regulation in the 1980s, coupled with historically low interest rates, created a fertile environment for the rapid growth of lower quality mortgages, what we now refer to as subprime mortgages.
Right.
And through the power of financial innovation, these higher risk mortgages were bundled together into complex new financial products, asset-backed securities,
But
CDOs.
distributed widely throughout the market.
Exactly. Eventually, as many of us remember, the widespread failure of these complex asset packages triggered the subprime mortgage crisis in 2008.
A huge global impact. Now let's shift our attention to China. How has this ongoing cycle of innovation, regulation, and crisis unfolded in their financial market, particularly with the rapid development of internet finance?
China offers a really fascinating and contemporary case study of this dynamic. Following 2013, there was a relatively permissive and open regulatory stance towards the burgeoning internet finance sector.
Kind of letting it run for a bit.
Sort of, yeah. This coincided with the massive expansion of mobile internet usage, allowing financial services to reach a far greater segment of the population at significantly reduced costs. We witnessed an incredible surge in mobile payments, for instance,
Like Alipay, WeChat Pay.
which has transformed daily life for many in China.
So in the initial stages, innovation in internet finance was given considerable room to grow. But were there downsides associated with this relatively lighter regulatory touch?
Absolutely. This rapid growth also brought about significant challenges. The inherent information asymmetry within financial transactions, combined with the extensive reach and rapid dissemination effects of the internet, made financial fraud much easier to perpetrate and more widespread.
Information asymmetry, basically. One side knows more than the other.
Right. And areas such as crowdfunding, peer-to-peer lending platforms, and even the cryptocurrency space became, as our source material described them, disaster areas, leading to substantial financial losses for many individuals and creating social instability.
Right. P2P lending had some major blowups.
It did. And this ultimately led to a more assertive regulatory response from the Chinese authorities.
Tightening the reins.
Exactly. Since approximately 2015, we've observed much more robust regulatory measures being implemented. And this really highlights a critical balancing act that all financial regulators face. How do you effectively mitigate the risks that inevitably arise from rapid innovation without inadvertently stifling the very dynamism that drives market development and efficiency?
And this isn't a challenge unique to China, is it? The global financial industry is undergoing a profound transformation driven by ongoing technological revolutions. Fintech, DeFi.
Exactly. Across the globe, financial regulation often lags behind the accelerating pace of innovation. Consider some of the pressing contemporary issues. How should central banks respond to the rise of blockchain technology and decentralized finance? How do we effectively safeguard privacy in an era of financial big data?
Big questions.
What are the appropriate regulatory frameworks for these massive financial platform enterprises? And how should we approach the regulation of innovative but highly volatile assets like Bitcoin? These are all very live questions that underscore this constant tension.
This brings us to a really crucial point you raised earlier, the underlying essence of financial innovation as a revolution in thinking, rather than simply the creation of new financial tools or technologies. Could you elaborate on that distinction?
Absolutely. When we typically think about financial innovation, our minds often go to the tangible outcomes, things like ATMs, the process of asset securitization, the structure of joint stock companies, or mobile payment apps like Alipay.
The tools, the products.
Right. These are all examples of what we might call tool innovation, new products, new organizational structures, new ways of trading. But this is really just the most visible layer. The deeper and more significant aspect of financial innovation is this fundamental shift in how we conceive of financial concepts and relationships. It's the revolution in thinking.
So the technologies and the products are the outward manifestation, the form, but the real driving force for change lies in these underlying conceptual breakthroughs, the soul, perhaps.
Precisely. These technological and tool innovations are the form, but the revolution in thinking is the substance, the essence. And this deeper aspect is often overlooked in mainstream discussions about finance, which is a shame because it's arguably where finance makes its most profound and lasting contributions to societal progress. To illustrate this, let's consider two key historical examples: the emergence of national debt and the development of joint stock companies.
Okay, let's start with the concept of national debt. Your source material suggests that a change in social understanding actually paved the way for the acceptance of debt, and that debt, in turn, played a significant role in fostering ideological enlightenment in Europe. That's a pretty significant claim.
It is. Let's consider the historical context. For a long time in Europe, lending money at interest was viewed as morally reprehensible, even illegal in many instances. Creditors were often stigmatized.
Because of usury laws and religious views.
Exactly. Why? Because interest, at its core, is essentially the pricing of time. And in medieval Europe, deeply ingrained religious beliefs held that time belonged solely to God.
So the act of charging interest was seen as essentially profiting from something that wasn't yours to begin with, almost a form of sacrilege.
Exactly. It was considered heretical to put a price on time, which was believed to be within God's exclusive domain. Now, just to provide a brief contrast, consider ancient China, where the concept of corvée labor existed, using one's time to fulfill tax obligations to the emperor. It's a different cultural understanding of time in relation to authority. But in Europe, the prevailing religious view reinforced this idea of God's ownership of time, making the charging of interest a contentious issue.
So this deeply rooted tradition significantly restricted financial activities and, perhaps more importantly, limited the development of new ways of thinking about value and exchange over time.
Absolutely. It wasn't until the 12th century that this tradition began to be challenged, notably in the city-state of Venice. Faced with mounting war debts, Venice innovated by issuing public debt, essentially borrowing from its own citizens and transforming them into creditors of the state.
A practical solution to a pressing problem. And this seemingly pragmatic financial maneuver had far-reaching implications that extended beyond simply managing government debt.
Precisely. Firstly, it provided citizens with a new investment opportunity, aligning their financial interests with the success of the state. But more significantly, it conveyed a powerful underlying message. Money is an item that can reproduce and generate value over time.
Money making money.
Right. In a deeply religious context where time was sacred, this was a revolutionary idea. It suggested that outside of divine creation, humans could create something through lending that could generate further value over time, essentially putting a price on time itself. This marked a significant monetization and secularization of the concept of time.
Wow, challenging the divine right over time itself. And this fundamental shift in thinking had broader ideological ramifications.
Absolutely. Even though some religious authorities continued to condemn national debt as a form of profiting from time, its practical utility in financing state functions, and the fact that citizens increasingly embraced it, led to its widespread adoption across Europe.
It just worked too well to ignore.
Pretty much. Countries began issuing national debt, even using it as collateral. This widespread acceptance fundamentally altered social cognition, secularizing and monetizing the concept of time on a massive scale. This liberation of people from God, in terms of how they understood time and value, laid a crucial intellectual foundation for broader social change and the European Enlightenment.
That's a really insightful perspective on the profound impact of what seems like a purely financial instrument. Now let's move on to your second example, the rise of stocks and joint stock companies. You argue that this also brought about a significant ideological shift, particularly in the Netherlands during the 17th century, with its strong tradition of civic participation.
Yes. If the emergence of debt was about liberating people from a particular way of thinking about their relationship with the divine, then the development of stocks was about liberating people from certain limitations in their relationships with each other, specifically in their ability to access and mobilize capital. I want to suggest a slightly different way of looking at social classes. Instead of solely focusing on traditional hierarchies like royalty and nobility, consider the idea that social standing is fundamentally influenced by the ability to gather and control financial resources.
That's an interesting lens. Access to capital as a determinant of class. How did the joint stock system alter this dynamic of capital mobilization?
Well, in feudal Europe, an individual's capacity to accumulate significant capital was largely determined by their inherited social status and their personal connections within those established hierarchies.
Who you knew, who your family was.
Exactly. Most people, bound by feudal obligations and lacking individual creditworthiness in a modern sense, couldn't easily access large sums of money. Often, warfare was the primary avenue for social advancement and access to resources. The joint stock system fundamentally changed this. It created a mechanism for pooling resources and sharing both the potential rewards and the risks of a venture.
Spreading the risk, pooling the capital.
Right. Suddenly, the project is the key. If an individual had a viable business idea, particularly in burgeoning areas like maritime trade, they had a potential avenue to raise capital regardless of their social standing. This opened up unprecedented opportunities for social mobility.
So it wasn't just about who you were, but what your idea was worth. And this newfound ability to pool capital had a significant impact on broader economic development.
Absolutely. The proliferation of the joint stock system provided a crucial capital foundation for the European Industrial Revolution. It facilitated the rise of a new class of industrialists and capitalists by enabling investment in ventures based on their potential rather than solely on the social standing of the individuals involved. Stocks played a key role in breaking down previously rigid social structures, leading to a profound social transformation.
So if debt liberated people from a religiously constrained view of time and value, stocks liberated people from the constraints of existing social hierarchies and personal connections when it came to accessing capital and pursuing opportunities.
Precisely. Debt offered a form of financial liberation from a divine concept, and stocks offered a form of economic liberation from dependence on specific individuals for capital and opportunity. This fundamental shift, this liberation, I argue, lies at the very root of European liberalism and represents a major, often overlooked contribution of financial innovation to the development of modern society.
That's fascinating. It's somewhat surprising that this isn't a more central theme in standard finance education.
It really is, though some economic historians like Hicks have certainly recognized the crucial role of these transformed social concepts in driving economic progress. He basically said the Industrial Revolution had to wait for a financial revolution first.
Right, the ideas had to change before the factories could be built on a large scale. This perspective really underscores that financial innovation can have profound and far-reaching societal and ideological consequences that go well beyond the creation of new financial instruments.
Hmm.
But let's shift our focus somewhat and address a more practical and immediate question. Is financial innovation ultimately a force for good or for bad?
That's a really critical question to consider. Initially, we often tend to have a positive view of financial innovation, right? We think about the convenience of things like Alipay and WeChat Pay in China, or the essential role of hedging instruments and managing risks for businesses engaged in international trade, makes life easier, manages risk.
Yeah, the obvious benefits. However, as we touched on earlier with Volcker's somewhat cynical view, regulatory authorities often maintain a more cautious and sometimes even critical perspective.
Exactly. Volcker famously joked that the automated teller machine, the ATM, was the only truly beneficial financial innovation banks had come up with in decades. A bit harsh, maybe, but it highlights the skepticism.
It does.
So the fundamental question remains, is financial innovation inherently a good thing or a bad thing? And the answer, as we've been hinting throughout our discussion, really lies in that complex and often tense love-hate relationship it has with regulation.
Okay. Can you illustrate this inherent duality with a specific example? You mentioned asset securitization earlier as a significant development in the U.S. financial market.
Absolutely. Asset securitization in the U.S. financial market serves as a really compelling example because it had both undeniably positive motivations and ultimately contributed to very negative consequences, making it something that regulators often view with a mixture of optimism and apprehension.
Happy and worried at the same time.
Pretty much. On the positive side, it emerged in part to address some fundamental challenges in the post-Glass-Steagall regulatory environment, specifically the liquidity and maturity mismatch issues faced by traditional commercial banks after they were separated from investment banking activities.
Remind us briefly about that maturity mismatch issue and why it was a concern.
Sure. Banks primarily take in deposits that are relatively short-term. Depositors can withdraw their funds on demand, right?
Hmm.
However, banks also make loans that are typically much longer term, like mortgages that can last for 30 years. This difference in the time horizon between the bank's liabilities, deposits, and its assets, loans, creates a potential liquidity risk. If a large number of depositors want their money back at the same time, the bank might not have enough liquid assets readily available because they're tied up in long-term loans.
Right, the classic bank run scenario.
Exactly. Asset securitization offered a mechanism to alleviate this. Essentially, these longer-term loans are pooled together, the stream of interest payments from these loans becomes a predictable cash flow, and then new securities bonds are issued against this cash flow and sold to investors in the capital market.
So it essentially transforms these less liquid, longer-term assets into more liquid, tradable securities, turns loans into bonds.
Precisely. This process unlocked the capital tied up in these long-term assets, allowing for a more continuous flow of funds and significantly expanding the size and depth of the U.S. financial market. You can see why regulators might initially view this as a beneficial innovation.
Yeah, freeing up capital, increasing liquidity. Sounds good.
However, there was a significant downside. This connection between the bond market and commercial banks, facilitated by asset securitization, created a new regulatory challenge. The existing regulations designed for traditional banks and for the capital markets weren't perfectly suited to this hybrid type of financial product and the complex ecosystem that grew around it.
Kind of fell between the cracks of existing rules.
Right.
And within this evolving regulatory landscape, further, more complex innovations began to emerge.
Exactly. We saw the proliferation of increasingly complex and highly leveraged instruments like resecuritization, packaging securities into new securities, and various forms of derivatives, all operating within what became a relatively less supervised shadow banking system.
Shadow banking outside the traditional regulated sphere.
Right. The scale of this market grew enormously. Asset securitization eventually represented over 30% of the entire U.S. financial market. And as these product chains became longer and more opaque, it became increasingly difficult for investors and even regulators to truly understand the underlying quality and risk of the original assets, those initial mortgages, for instance.
Hard to see what was really inside the package.
Very hard. And as we all know, the widespread failure of these complex securitized products played a central role in the 2008 subprime mortgage crisis.
So a financial innovation that initially aimed to improve market efficiency ultimately contributed to systemic risk in the absence of adequate and adaptable regulation. You mentioned other financial innovations like money market funds and high-yield junk bonds as also arising from this interplay.
Right. Many of these innovations emerged from this constant push and pull between market participants seeking higher returns and regulators attempting to maintain market stability. The inherent paradox is that innovation drives market expansion and offers new opportunities, but it also frequently seeks to circumvent existing regulations in the pursuit of greater profitability.
Finding the loopholes or just operating where rules haven't caught up yet.
Exactly, which can create unforeseen vulnerabilities and the potential for instability. I really like the analogy from our source material that describes financial innovation as a smart but naughty child.
Huh.
Explain that one.
Well, it's capable of achieving great things if guided responsibly, but also prone to causing significant trouble if left unsupervised.
That makes sense. And the regulatory response often seems to oscillate between periods of stricter rules following a crisis and periods of deregulation aimed at encouraging market activity and growth. Exactly, it's this ongoing cycle. Let's go back to China's experience with internet finance. The initial relatively hands-off approach certainly fostered rapid growth and the widespread adoption of mobile payments, which has clear benefits for consumers.
Huge convenience.
But it also created a breeding ground for financial fraud in areas like crowdfunding and peer-to-peer lending due to the information gap between platforms and users and the rapid spread of information online. This resulted in significant financial losses for many and led to social unrest, ultimately necessitating the significant regulatory crackdown we've seen since 2015.
That painful rectification period.
Right. It's a perfect illustration of how innovation can be a double-edged sword.
And as technological advancements continue at an ever-increasing pace, AI and finance, quantum computing potentially impacting cryptography, this fundamental challenge of balancing the potential benefits of financial innovation with the need to mitigate the associated risks is only going to become more complex for regulators worldwide.
Absolutely. The core question remains, how do we ensure that financial innovation ultimately serves the real economy and promotes broader social well-being while effectively minimizing its potential negative consequences. Financial innovation is not going to stop. Technological progress guarantees that.
No stopping it.
Therefore, we need to be continuously exploring new regulatory approaches and concepts to adapt to this constantly evolving landscape.
So to recap our deep dive today, we've explored the recurring cycle of financial innovation, regulation, and crisis, using compelling historical examples like the South Sea Bubble and the more recent experiences of the US and China.
Mhm.
We've also delved into the concept of financial innovation as a fundamental shift in thinking, illustrated by the transformative impact of debt and stocks,
That revolution in thinking.
and highlighted the inherent love-hate dynamic that exists between innovation and regulation.
And the real takeaway here, the aha moment, is hopefully gaining a deeper appreciation for this ongoing interplay and understanding its historical roots. It provides, I think, a much more profound and nuanced perspective on how financial markets evolve and function.
Right. It's not just random events. There's a pattern, a dynamic at play.
Huh.
This leads to a crucial question for you to consider. Given the ever-accelerating pace of technological innovation within the financial sector, how can regulatory frameworks adapt and evolve to effectively foster beneficial innovation while proactively mitigating systemic risks in the years ahead?
Yeah, that's the multi-trillion-dollar question, isn't it?
It really is.
Yeah.
It's about finding that critical balance between enabling progress and ensuring stability in an increasingly complex financial world, something to definitely keep thinking about. We genuinely love to hear your thoughts on this. Jump into the comments section and let us know what resonated. Which type of wealth are you focusing on?
Yeah, let us know.
And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.